This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asia is set to extend a stock rebound as dip buyers emerge ahead of the US inflation numbers. Traders cutting the chance of a jumbo Fed rate cut next week to about 20%. Apple shares closed flat after it unveils its latest iPhones, featuring modest hardware upgrades and AI technology that isn't quite ready yet. Plus, the Fed is set to slash increased capital requirements for big US banks in a dramatic retreat following fierce lobbying by lenders.
Heidi, we saw calm returning to the markets overnight in Wall Street. Of course, we did get a little bit of bargain hunting supporting the equity space, but this is before we get CPI numbers also on Wednesday. Now, options traders pricing in about almost a 1% move in either direction for the S&P 500, depending on how these numbers come out. And the expectation right now is for 2.6% gain year over year for the month of August. That would be the smallest increase since 2021. We saw a New York Fed survey also showing that consumer inflation expectations have sort of stabilized.
What hasn't really stabilised is this sort of deflationary spiral that we're seeing in China, right? We've often talked about, well, how long until policymakers take sort of more stringent action against this risk of the deflationary psychology setting in. And we are starting to see that fears of that, right? It's been stalking China since last year. It's now showing these signs of spiralling, and that could potentially, in the longer term, worsen that structural slowdown for China's economy. It's raising calls, certainly, for more immediate and severe policy action. Prices are seen falling through all the way through 2025. We're seeing stagnation when it comes to wages, when it comes to languishing domestic demand. And we know, Shery, from just the Japanese experience of now finally emerging after these painful deflation years, what happens when that mindset becomes entrenched?
Yeah, and if we continue to see really that decline in the Chinese economy, we could see that pressure mounting on the Chinese yuan as well. Remember, we've seen that upside of about 2% this quarter against the US dollar. But will there be repatriation of dollar holdings if there really isn't that appetite to invest within the country? We'll be watching as we also continue to watch the Japanese yen. Of course, Heidi, that 143 level is still being held. Nikkei futures at the moment pointing to the upside of 0.2% after 5 sessions of losses already. We have Sydney futures also pointing higher. We have the dollar gaining ground in the overnight session. Take a look at how U.S. futures are coming online. We had 2-year Treasury yields really getting a boost, although the Treasury markets was a little bit mixed. But we're really watching, of course, and what we'll be watching in the Asian session as well, Apple suppliers, because we saw Apple gaining almost 2% at one point during their product launch. It almost ended unchanged. So that was one of the big moves that we saw in the equity markets. But really, it was about that sort of appetite returning for risk assets. We saw the VIX index, for example, fall below 20 as well. Although, put it into context, we're still about 50% higher than the yearly average, Heidi.
Yeah, and of course we're watching when it comes to the Asian session how some of these Apple suppliers might react, with Apple introducing the latest versions of its flagship iPhone, betting it can entice consumers with some pretty modest hardware upgrades, promises of AI technology that won't be included in initial models. Our Bloomberg technology co-anchor Edward Lowe joins us now from Cupertino. So, Ed, there was a real managing of expectations certainly going into this. We knew this wasn't going to be, you know, the sort of big bang new product release. So what did we actually get?
Well, we got a next generation iPhone 16, that's still the centerpiece, but with very modest hardware modifications or changes from the prior generation. And, you know, while the narrative was very much about Apple Intelligence, Apple's AI offering, you have a state of play now where the new iPhones are available for pre-order today, right now, and they ship on September 20th. But Apple Intelligence in the first instance will only ship in a very sort of limited form in iOS 18.1 in October. And so we just kind of really wanted more, although it's interesting to look at the stock. It's flat. You guys pointed that out. But in 12 of the 17 iPhone launches prior to today, the stock closed down. And given kind of how the stock's traded so closely to Apple's AI story, you'd say that actually, all in all, there was enough to convince investors on the path forward for Apple and AI here.
And you mentioned in our T-Live blog about the fastest CPU of any phone. Does that warrant a big refresh cycle here?
It's a really good question because, there isn't that much different really between what we got with iPhone 15 a year ago and now. But you take for granted the things that are important to consumers. That includes consumers in China. And even though the consumer in China won't have access to Apple Intelligence in the first instance, things like processor performance, battery life, the quality of the materials, Apple is still an aspirational product in many Asian markets. Those things really matter. And so while there weren't sort of specific hardware, aesthetic or design changes, the performance and the quality of the materials in this generation of iPhone are a step up, and Apple were very keen to make that point.
We saw Apple shares hitting that record when it did the whole sort of AI for the rest of us release, right? So how much does, I guess, future growth and success really hinge on the ability to deliver on these AI features? And when could we possibly see them, I guess, in full flight?
Yeah, look, I was able to get hands-on with some of the beta versions of Apple Intelligence. And the easiest way to summarize is they are tools that make things you already do on your iPhone slightly easier, slightly more convenient. Summarizing dense bodies of text, auto responses, photo editing. But the really big stuff is still to come. It's going to be this staggered release. The pessimist would say we haven't learned enough about how we're really going to use Apple Intelligence. The optimist would say, actually, there could be an upgrade cycle driven just sheerly by anticipation. Buy yourself the latest iPhone 16 generation, knowing that Apple is sort of staggering the release of this functionality. And that might be really interesting, particularly in markets like China, where the regulator needs to sign off on it and Apple find a technology partner there. So in China, the consumer won't get Apple Intelligence. Doesn't mean they won't buy the handset. They might, because they know it's coming down the line.
Ed, what did you make of the pricing framework here?
Yeah, pricing is really important. And on the Pro, consistent, $999 US. The Pro Max, $1,199. It also makes me think about wearables. Probably the most significant refresh of product was in the wearables category. Refresh on AirPods, Apple Watch Series 10, with sleep apnea detection. The reason I bring that up in the context of price point is there are going to be consumers around the world who won't pay $1,000 for a smartphone, but they will pay several $100s for AirPods or a watch. That brings them into the Apple ecosystem and gets them exposure to Apple's services offering as well. And it's a really important jumping in point for Apple in lots of markets around the world. It was interesting to see some changes there.
Bloomberg Technology co-anchor Ed Ludlow there with the latest Apple release. And one of the other sectors we've been watching, of course, overnight are the big banks, right? In terms of these changes when it comes to the capital requirements for big American banks. This is a scoop that, really is quite significant in terms of the biggest US lenders now facing a 9% increase in capital requirements. That's a big retreat from the original proposed plan. Regulators have agreed after intense lobbying to these sweeping changes to a proposed package of rules. This is according to Bloomberg reporting and speaking to people familiar with the matter. So this plan, of course, by the Fed, the Federal Deposit Insurance Corp and the Office of the Comptroller of the Currency had called for a 19% jump in the capital that the 8 US global systemically important banks have to hold. These are banks like Bank of America, JP Morgan Chase, this cushion against unexpected losses and financial shocks, right? So this is a big turnaround that we're seeing, Shery, if this reporting turns out to be the changes that we see.
And so much back and forth since the capital requirements were announced first in July 2023, right? I mean, we went down with the Fed's proposal to as much as 5% for a broad group of U.S. banks from the original double-digit jump that we were expecting from the capital requirements in the original plans. We still have the 60-day comment period, and banks are expected to try for an extension. So we'll continue to watch how this unfolds. But right now, Bloomberg reporting from sources close to the matter that we will see only a 9% increase in capital requirements. Coming up on the Asia trade, AlphaSimplex and UBS Wealth Management join us as markets brace for next week's Fed meeting. We'll also delve deeper into Apple's latest AI promises with Lopez Research and an exclusive conversation with Wesfarmers CEO Rob Scott as Australian consumers slash spending. We have plenty more ahead. Stay with us.
September 10th. As Election Day approaches, Vice President Harris and former President Trump hit the stage for the first time.
Oh, we're going to beat her. I look forward to the debate.
If you got something to say it to my face.
We'll bring you informative analysis.
Will that debate decide the outcome of this election?
It's going to come down to both policy and performance.
Tune in to Bloomberg Television for the ABC News presidential debate simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
We have breaking news. The U.S. House of Representatives has passed a bill that would ban 5 Chinese biotech companies from receiving federal contracts. That includes BGI Group, MGI, Complete Genomics, WuXi Biologics, Cayman, and WuXi AppTech. And backers of the bill have expressed concern that Chinese companies could grow to dominate the biotech space. They talked about potential effects on national security as well as the economy, and they've said that American tax dollars should not finance the growth of Chinese tech. This also, of course, comes after earlier this year, Congress passed legislation signing into law banning TikTok unless its Beijing-based parent ByteDance actually divests. Now, with this biosecure bill being passed by the U.S. House of Representatives, we might see senators considering adding the legislation to the chamber's annual defense policy bill. So we'll be continuing to watch how this bill unfolds and whether this actually becomes legislation. But the U.S. House of Representatives has now passed a biosecure bill targeting 5 biotechnology companies from China from receiving federal contracts. Heidi.
Shery, in the meantime, take a look at how we're setting up in the session. We're just about 45 minutes away from the start of trading across major markets, and we are seeing broadly Asian stocks are set to track that rebound that we saw on Wall Street that was largely fueled by bouts of dip buying ahead of the US CPI data due out later this week. Of course, that could give us some more clues as to the scope of Fed easing going forward. At the minute, though, you're seeing quite a bit of upside, a pretty strong start to trading expected for Sydney. Futures up by about 1%, a little bit more moderated when it comes to Chicago traded Nikkei futures at the moment. S&P futures up by about 0.1%. We're also seeing some strength when it comes to the dollar as well. It rose basically against all G10 peers, on pace for would be the best day in more than a week. Those front-end Treasury yields rising ahead of the inflation numbers, and also the presidential debate is at play here as well. Let's bring Katy Kaminski, who's the Chief Research Strategist and Portfolio Manager at AlphaSimplex Group. So, Katy, September is typically, historically, not a great month when it comes to risk assets and certainly not for US equities. But is there a sense that perhaps at least going into November, the outcome of the US election and perhaps even going forward, that the volatility at this part of the market cycle might be here to stay?
Definitely the case, because I think we have so many things on the horizon right now, especially with rate cuts on the table. What is the pace? What is the size? Outside of just the election alone, there's already so many things that are uncertain at this point as we've shifted from a world where we're very focused on inflation to a world where we're worried about the labor market, economic weakness, and other factors. So I think this volatility is here to stay.
How do you navigate that?
Well, the challenge with navigating that type of volatility is that we're still trying to discern what are some of the key trends. So what we have actually seen is that a lot of investors have been fleeing more towards fixed income, and fixed income signals have been much stronger. So a lot of people are looking for safety outside of equity markets. You're also seeing some interesting plays across the commodity sector. We've seen a lot of short positioning, short views in commodities, and also currencies have been interesting as well as people are trying to navigate what is the impact of cuts on the US dollar versus other regions.
Yeah, so no haven flows into the US dollar given what we're factoring in with the Fed?
Well, the interesting point is you've actually seen the dollar has been quite under pressure. What's confusing about the dollar is that when the equity market goes down, the dollar typically is a beneficiary of that. But in the wake of cuts, the dollar has also been very strongly linked to Fed policy. And so with hikes, the dollar has been really strong, especially last year and for quite some time. But now we're seeing a lot more pressure on the dollar. This is particularly as in the last month or so, as you've seen that hikes becoming more and more likely to occur, and that the size has actually been negotiated, and people are thinking hikes might be stronger than we thought, which will put more pressure on the dollar right now.
Catherine, we're also seeing news that the biggest U.S. banks could be facing only a 9% increase in capital requirements. That's really down a lot from the original 19%. How are you looking at the financial sector, especially in light of the Fed rate cuts to come?
Well, the financial sector is always a tricky one because, of course, when you're thinking about rate cuts, it's obviously going to hopefully stimulate the economy and help us navigate sort of what could be the ramification of having that tighter policy for some time period. It is possible that part of the reason that those requirements were not as high has to do with the fact that, there is some concern that there will be implications from having tight policy for such a time.
When it comes to the broader equity markets, Haidi alluded to the volatility that we've already seen, of course, and what we're headed to in September. How does that translate to other equity markets around the world? Could we see flows, especially perhaps trying to hedge the volatility that we might expect in the U.S.?
Well, this is a good question, but I wish the picture was more clear. And the reason why I answer it this way is that if you look at China clearly and look in Asia, there's definitely a lot of dispersion with should you be investing in Japan, given the situation right now. Also, China has been in a very difficult situation, focused on some economic slowdown and potential disinflation. So, and Europe has had its own issues as well. So I think that's why investors are a little bit concerned about where do you hedge. And that's what my view is. It may not be in equity markets. It may be thinking about other asset classes, which might provide better hedge-like properties during this type of environment.
We're also looking at the sort of, intensified focus on the US presidential debate, right? Where do you expect the biggest reactions, if any, to be in the markets to this to and fro between the two candidates?
Well, I think the U.S. markets, the challenge is that it's so tight and that you're in a situation right now where for equity markets, there's really no clear answers to where this election is going to go yet. And so I think until we have a little bit more clarity, and so far there really hasn't been much, you're going to continue to see a lot of swings about what are the ramifications of policy if it's very unclear where the election goes. And this is going to obviously permeate into other markets outside the U.S. that are also concerned about what the ramifications of the next candidate who gets elected may be.
One of the other uncertainties, of course, is just how much a drive of big tech and the Mag 7 have been for these US markets, right? If you take a look at the kind of disappointment over the new Apple iPhone features, the disappointment obviously over Nvidia, none of it was bad news, but do you think the sentiment is going to be skewed to more being prone to selling off on news developments and releases from now?
Yes, I do. And the reason is when you're in a situation with high valuations, where a lot of investors are sitting in a scenario where valuations are already come so far, it's hard to know, where do you go from here? And I think with a very saturated investment universe where certain sectors have outperformed so strongly, you have a much higher probability of a reversal and sort of that take profit type behavior. And that's exactly what we've seen in the last few months, perhaps starting as early as June.
Katy Kaminski, good to have you back. A chief research strategist at AlphaSimplex Group with her takes on the broader markets. And coming up, Donald Trump and Kamala Harris prepare for what might be the biggest night of their campaigns. We'll look at what's expected from the U.S. presidential debate next. This is Bloomberg. Latest polling points to a tight race in key states between Democratic presidential nominee Kamala Harris and Republican Donald Trump. That's ahead of their first televised debate tomorrow. Bloomberg White House and politics reporter Stephanie Lai joins us now from New York. And Stephanie, this is a very much anticipated face-off. The stakes are pretty high.
The biggest moments for Vice President Kamala Harris, who up until this point hasn't done many interviews with the press, hasn't quite engaged with the media in the national press in the way that Donald Trump has for the last, 8 months to a year. And so this is really her moment to introduce herself to voters who might be learning about her story for the first time. At the same time, Donald Trump has had the last year and a half to really build out his policy portfolio. So this is Harris's moment to really tell the American voters what her vision is if she's given a term.
Part of Donald Trump's vision is to force dollar dominance, right? To tariff countries that try to de-dollarize.
Certainly. That's actually something that we heard at a rally on Saturday in Wisconsin. He threatened to tariff any country 100% if they should move away from using the U.S. dollar in trade. Now, this is something that Bloomberg scooped earlier that his advisors were discussing, but there are other options. And so this just builds into his robust tariff policy. This seems to be his solution for a number of issues. When it comes to trade policy, his go-to line is that if a country sets a tariff on U.S. goods, we'll set one at the same rate for their goods as well. And he claims that this will enable the U.S. to drive in a new revenue stream that would help offset the government deficit that we're currently facing.
Stephanie, when it comes to China, what are the stances that we're expecting? I mean, we just had the House passing the Biosecure Act to really bar those federal contracts from going to 5 Chinese firms. It seems that across the aisle, it's going to be going hard against Beijing.
That is certainly correct. And I think it's not just something that Donald Trump has been focused on, but as you mentioned, this is something that Democratic lawmakers are taking a stronger stance against as well. From the former president's stance, he's mentioned a number of things, but he does often claim that he has a good relationship with President Xi. But at the same time, he's not going to allow Chinese firms to gain an upper hand when it comes to manufacturing. One thing that he often touts is that he really wants to focus on artificial intelligence and cryptocurrency as a way of competing with China. So there are many different ways in which he's using economic policy to target the nation's competition with China.
Bloomberg White House and politics reporter Stephanie Lai there ahead of this highly anticipated debate. Let's take a look at how US futures are shaping up at the moment. We're seeing quite a bit of upside. Their market's kind of awaiting not just, of course, the political developments in this Harris-Trump debate, but also US CPI, which could more broadly shape the expectations of what we're getting from the Fed going forward. We are seeing a bit of upside there when it comes to trading in S&P futures. A bit more of a risk when it comes to some of these tech stocks, right, particularly with the weakness in Apple, the sort of disappointment over the modest upgrades to its new iPhone. Dow futures are looking pretty flat at the moment, with Asian stocks set to track that renewed dip buying rebound that we saw on the Wall Street session. More ahead on the Asia trade. This is Bloomberg.
Take a look at some after-hour moves. Big gains for Oracle right now. They are jumping after reporting quarterly profit and bookings that topped estimates. Really a signal that AI demand could continue to boost its cloud computing business. A lot of focus, of course, on the AI capabilities that Apple is bringing forth. We had the product launch, and really what we heard was the Apple intelligence features would only be released on a staggered basis in 2025. Let's get more on Apple and bring in Maribel Lopez, founder and principal analyst at Lopez Research. Maribel, great to have you with us. Is it a bit concerning that we've seen these delays when it comes to the launch of Apple Intelligence and the key features will not really be released until next year as well?
I think the reality is that while Apple is all in on intelligence, really consumers aren't quite sure what they're going to do with artificial intelligence. So they aren't actually really missing it now. And I think we have to also keep in mind that these phones aren't going to be in people's hands until Q4, probably closer to the end of the Q4, beginning of Q1. So they'll start to see what would look like a continuous upgrade cycle. Ideally, would it have been nice to have it all come out on day one with the iPhone? Absolutely. But I actually think that we're overplaying the delay in the AI software features at this point. I think the main thing for customers is to know that they're investing in a phone today that's going to allow them to do whatever comes next for at least the coming 2 years that they're going to be holding that phone.
It was really interesting that Apple's stock actually finished unchanged. When it comes to the day of the launch, we usually see downside pressure because people are selling the news. Could that mean that investors are a little bit more optimistic about other features as well?
I think right now there's a few things going on with Apple stock. First of all, we've always had that bounce. It goes down, it comes back up. There was lack of enthusiasm. I think what we saw in this cycle is that we weren't actually expecting a big bang upgrade. We were all expecting them to be all in AI. They did talk all about AI, and there were actually some interesting features. And the watch actually overperformed where most people expected it to be in terms of having a bigger screen, thinner, lighter, sleep apnea, and the AirPods with the hearing assistance that they've put into it could be a really interesting longer-term strategy for Apple in the health market, but also Apple being able to get AirPod upgrades on a more consistent basis, because that will become a critical feature for a certain category of users. So I think when you put all that together, we kind of came out and said, it's about what we expected, a few surprises, but nothing that blew the doors off. Apple's been pretty consistent with the cadence of what types of hardware innovations and what types of software innovations we were expecting. Most people didn't expect them to push the envelope and build the thing that was so far out that nobody expected. They're really good at that incremental innovation that sort of surprises and delights the users from a usability standpoint.
And to that point, you think the new chips are perhaps, or should be outweighing the, I guess, relative disappointment over the timing of the AI features?
I think in general, the AI market right now is all about chips. Whether you're NVIDIA or Apple, it's do you have the right chip to do the job moving forward? No one wants to invest in hardware that they think is going to be stranded a year or two down the road. So the A18 chip, I think, was the star of the hardware performance in the show.
When you take a look at the competition, and you've talked about the fact that we've seen companies like Huawei really manage to close the gap, right? And in fact, they scheduled their release just hours after Apple's. How successful is Apple been at being able to sort of fend off competitors, particularly when it comes to markets like China?
I think at this point, Huawei has actually done a tremendous job of really demonstrating some interesting hardware innovation and leadership throughout the category, really grabbing the Asian marketplace right now. We expect to see them continue with that. We know that there was going to be a big shift in China, more towards Chinese manufacturers to begin with. There's been a lot of discussion about sanctions from both countries. So therefore, this is not a big surprise to me. I think the timing of their launch was very strategic. I think the pre-orders to sort of undermine the confidence in what Apple could possibly come out with was very strategic timing. And I think they're going to continue to place well over the next year. Does that mean that Apple's out? No, I actually don't think that Apple is out. It's just, it's a much more competitive landscape. And I think what we're really seeing is that most of the innovation you're going to see over the next year or two is going to be in software. And that's actually really difficult to market and very difficult for consumers to understand. So really trying to distill it into, how does it make the camera better? How does it make the audio visual better? What kind of videos are you going to capture? How are you going to express yourself with emojis? These are things that I think we're going to see a lot more focus and emphasis on, is like, what does AI do to really make your life better, as opposed to we just slapped the word AI onto it and called it intelligence, and now therefore it's better. So looking forward to seeing what these new AI features are across the board from all of the smartphone manufacturers.
I gotta say, I was very much excited about the physical button when it comes to the camera in the new iPhone 16. But given that we didn't see that major hardware shift, what does that really signal about where Apple sees growth, especially given that some competitors have had those foldable phones being all the rage among its customers?
First of all, I think Apple has fully decided that foldable is not a key requirement for the smartphone market. Foldable products are extremely expensive. They're not able to go mainstream at this point. They're very sexy, but if we're really trying to get a consistent cadence of upgrades, the cost of that technology is often not worth the trade-off for most people. So while I think it's a really cool, sexy form factor, Apple doesn't seem to think it's going to need to have that product anytime soon, and it doesn't seem to be missing a beat in terms of continued smartphone sales as a result of it. So I think their strategy is proven out in the short term. In the long term, do we expect to see something in foldable? I think they need to spend a lot more of their energy on getting that artificial intelligence right, and if they don't get that right, it's game over for anybody that misses that boat right now.
Maribel Lopez, founder and principal analyst at Lopez Research. They're taking a look at banks now, some of the stories that we're following. HSBC is said to be considering combining its commercial and investment banking units as part of CEO George Eldery's push to eliminate overlapping roles and cut costs. Sources say the combined division will boast 90,000 employees and become the bank's largest revenue generator, contributing about $40 billion a year. Eldery has emphasised that he intends to continue a strategy of pivoting the bank towards core markets in Asia. Goldman Sachs CEO David Solomon is warning that business for the bank's trading unit is on track to drop 10% from the prior year. That's led by declines in the fixed income business. The company will also take a $400 million pre-tax hit in its consumer business as it moves away from its credit card tie-up with General Motors.
First, with respect to trading, I would say that with FICC and equities, we had an extremely strong third quarter in 2023. And given this quarter, given what I'd say is a more challenging macro environment, particularly in the month of August, that business is trending down close to 10%, largely due to FICC.
Standard Chartered CEO Bill Winter says Southeast Asia is becoming an extremely attractive place to invest. This is geopolitical tensions rise in other regions. He spoke to us during Bloomberg Spotlight on the ASEAN Business event in Singapore.
Yeah, it's kind of interesting to note that in that huge FDI gap, a big chunk of the FDI investment into ASEAN has come from China. It's come from Chinese companies who themselves are pursuing the China Plus One strategy for both economic reasons and also geopolitical. So I think there's just a tremendous confluence of trends which are making ASEAN an extremely attractive place to invest. You've had economic and political reform. Obviously, in particular, we're talking about the bigger markets, where you've got excellent underlying policy reform and policy platforms. You've got, of course, all the benefits of China Plus One. You've got an extremely experienced and still relatively low-cost workforce, although I think that will converge over a relatively short period of time. And you've got political stability. The fact that ASEAN as a bloc is beginning to come together is encouraging, but I will say maybe on a scale of 1 to 10 in terms of the migration towards a real trade bloc, we're probably still at a 3 or a 4. That to me is enormous upside, and we're very keen to hear from the minister on that because I'm sure that's a big part of what you're focused on. So overall, the confluence of trends, some self-generated from within the ASEAN countries or within ASEAN itself, some external environment, play to the strengths of ASEAN. We're absolutely delighted to be present in all 10 of the ASEAN markets, although the minister reminded me that there's the prospect of ASEAN expanding to 11. So I asked Ben whether we'll be opening up in East Timor anytime soon, and as yet we do not have an East Timor presence. So Ben, Patrick, you're going to have to get on that case because it's quite compelling to be able to say that we're operating across ASEAN. But in terms of the major trade flows, trade corridors, investment corridors, between ASEAN and China, ASEAN, the rest of Asia, ASEAN and heading west, this is where the action is, certainly in our bank, and I think it's where the action is in the world to a very substantial degree.
Standard Chartered CEO Bill Winter speaking at Bloomberg Spotlight on ASEAN Business event in Singapore. More ahead on the Asia trade. This is Bloomberg. Take a look at how we're faring just about 15 minutes away from the start of cash trading here in Australia. We're seeing Sydney futures looking like we'll see a pop at the start of the session, up just about 1%. The Aussie dollar actually holding pretty firm despite that recovery rally that we saw for the US dollar, on track for its best performance in over a week as we await US CPI numbers and watching, of course, bond yields as well as we get towards those inflation numbers, which should give a pretty good indication in terms of the expectations of the scale of Fed easing from here. Of course, what is not easing is the RBA. We've heard from Australian Treasurer Jim Chalmers saying he is disappointed, not surprised that the opposition has rejected his central bank reform deal.
The position that has been reported from the coalition is irresponsible, it's disappointing, but it's not especially surprising. We'll consider the next steps. All options are on the table, but my preference hasn't changed. You know, I'd prefer a bipartisan outcome in the Senate.
Let's bring our economics reporter Swati Pandey, who joins us in Sydney. So why was this rejection the position that the opposition took?
The RBA reform is about creating two boards. One is the Monetary Policy Board and one is the Governance Board. And the opposition wants that the entire board moves to the new Monetary Policy Board, whereas the Treasurer is saying that some people will move to the Monetary Policy Board, while some will have the option to move to the Governance Board. And the opposition is not agreeing to that point of view because they say that this will give the opportunity to the Treasurer to make new appointments in the interest rate setting Monetary Policy Board, which they do not want. They have also said they have deep concerns about the intention of the government, and they also are concerned that the fact that the Treasurer and some people from the Labour Party have recently criticized the RBA for anemic economic growth, and they just generally have concerns about the government's intentions.
Have we heard from Michelle Bullock on this?
Michelle Bullock has said repeatedly that she would prefer continuity on both boards, which means she's basically siding with the Treasurer, Jim Chalmers. She has said she would be happy for the legislation to go through because they're kind of like in a bit of a limbo at the moment. There were some changes that the reform had recommended, the review had recommended, which the RBA has already implemented. And then there was some which needs the legislation to pass through, and that is stuck. So the RBA does want this to go through, but their position is more in line with what Chalmers is suggesting.
So what happens now? Is the reform dead, or?
It could be dead, but Chalmers, obviously it is Chalmers' signature reform, and he wants to make it see the light of the day. So he is agreeing to discuss this with the minority party, Greens party, which was not his initial preference because that may mean some radical changes to this particular reform or some negotiation for something else, right? So his preference is still bipartisan support, but in the worst case scenario, he is happy to cut a deal with minority parties as well.
Our economics reporter Swati Pandey there. Take a look at some morning calls ahead of the Asia trading day. We're just about 15 minutes away from the start of major Asia markets, I should say, coming online. Morgan Stanley says it's moving to a cautious approach on emerging market sovereign credit. Strategists recommend that investors go bearish on the asset class in the short term. They favour investment-grade notes over riskier debt. They're also suggesting selling an EM index of credit default swaps. The bank says a Fed rate cut is unlikely to spur meaningful inflows at bond funds. A former senior official at Japan's financial watchdog says the BOJ is still in a position to hike rates again by year-end. Tomoko Amaya says the market has sufficiently stabilised to keep a rate move on the table. Most BOJ watchers see the central bank raising rates again by January, provided there's no return to the market instability, Shery, of early August.
Yeah, which is why we saw really that upside in the Japanese yen against the US dollar, especially given the trajectory that the Fed is going to cut rates most likely this month. We're seeing a little bit of downside for the Japanese yen at this session, though. The US jobs data that came out, investors saying that they weren't necessarily weak enough to justify that outsized Fed rate cut. So we saw a little bit more weakness on the yen, and also the dollar demand sort of seen in response to Japan's GDP final numbers coming in a little bit lower than expectations this week. But the yen's rebound recently really spurring that rollback of exchange rate hedges by global investors, no longer afraid of a rapid slide in the Japanese currency. Our Asia Equities reporter Winnie Su joins us now with more, so a little bit perhaps more confidence on the stability of the yen, but how are investors really repositioning their investments?
Yeah, so like you said, there's so much moves in the yen, so people are really scrambling to understand how they can protect their investment by hedging or unhedging. And now we're seeing lots of investors actually taking off that hedging on Japanese stocks right now. That's according to JP Morgan that recommend such move recently, and also UBS having a similar recommendation as they now expect the currency, the Japanese yen, to trade at 160 against the dollar by year end versus 155 earlier before the Bank of Japan decided to raise rates in late July. So that kind of recommendation is really showing how the sentiment has been changing. And what's interesting is how fast that's been evolving, right? So earlier in the year, people were recommending to unhedge because they were expecting a stronger yen and a hawkish Bank of Japan. But that changed throughout the year, and now we're back at unhedging. So it's very interesting to kind of observe and to see how investors are changing their strategies around that.
And the outsized move on the equity markets, right? We're down for a fifth consecutive session. And where are we headed here in the near term, especially when we are seeing these moves in the yen?
Right. So a lot of cautious mood in the near term, I would say. On one hand, you have, like you mentioned, people are worried about the yen's appreciation to hurt stocks, especially the earnings outlook for exporters. And we actually had UBS downgraded Japanese stocks to underweight when it comes to local currency terms, because they're worried about the global economy slowdown and also Japanese stocks that are exposed to the slowdown in Chinese economy. And also they're saying that the unwinding of the carry trade, only 50% of that is done so far since 2012. So there's more to the room of yen appreciation. So that's going to weigh on Japanese stocks in the near term. However, on the other hand, you just had JP Morgan today had a note reinforcing that view of overweight on Japanese stocks, citing that if we're unlikely to see a rapid appreciation of the yen, the earnings are likely to be manageable in terms of how much the yen can strengthen. So what they share in common is that they're still quite cautious in terms of the volatility in the market, and sentiment remains quite weak after that big sell-off in August.
It's been really interesting to see some of the smaller moves within the broader equity markets, because one of my favorite stocks, Nitori, the furniture maker, domestically oriented, has jumped this year because of a stronger yen. Are there any sectors in particular that you're watching?
Right. So Nitori is definitely one of the domestic demand-driven sectors, right? So lots of investors are tuning into that sector because that's going to be a beneficiary when it comes to yen appreciation. And when we talk to strategists, they mentioned that the retail sector that are showing some good signs when it comes to the monthly sales data is actually reinforcing that view as well. And other investors say that they are still quite positive around the sectors that can benefit from the corporate governance reform. On the other hand, exporters obviously will be hit by the stronger yen, and also those sectors that are exposed to demand from China.
Our Asia Equities reporter Winnie Su here in the Tokyo studio with what to expect in the Japanese markets. And be sure to tune in to Bloomberg Radio to hear more from the day's big newsmakers. Get in-depth analysis from the Daybreak team, broadcasting live from our studio in Hong Kong. Listen through the app, Radio Plus, or BloombergRadio.com. Plenty more ahead. Stay with us.
Latest on the corporate front, and Honda will reportedly reduce staffing at its Chinese joint venture with Dongfeng Motor. Japan's Nikkei says the voluntary cuts apply to production workers at 3 factories that mainly produce petrol-powered vehicles. It is Honda's second joint venture in China to undergo job cuts this year as the company moves towards electrifying its products. Oracle shares surged in late trade after better than expected quarterly profit, signalling that AI demand continues to boost its cloud unit. CEO Safrakat says cloud services have become Oracle's largest business as quarterly revenue rose by 7%. It also announced a new agreement to make its namesake database available on the Amazon Web Services cloud. Media has started taking investor orders for its share sale in Hong Kong, which could be worth as much as $3.5 billion, would make it the city's biggest listing in more than 3 years. The Chinese appliance maker says it expects to price the shares on Friday and start trading a week from today. Sources say order books were covered as of Monday, with cornerstone investors taking more than a third of the offering.
And Heidi, some of the stocks that we'll be watching at the open of trade in Korea, Japan and Australia. Of course, those Asian Apple suppliers in focus. We could see them move after the firm revealed its latest devices, including the iPhone 16, as well as new watches which tout AI features, and keep watching those stocks on the board right now. Of course, we had a little bit of a mixed picture with some of those semiconductor names actually taking a hit last week with the decline in NVIDIA, 14% loss in the last week. But this is a picture right now as we set up to the market opens. We're seeing a little bit of upside for Nikkei futures. This after 5 sessions of losses already. We had seen the Japanese yen strengthen. We've seen big moves for the yen right now. A little bit of weakness against the U.S. dollar as U.S. futures are also holding pretty steady. Of course, we are headed to the CPI numbers on Wednesday. Options traders pricing in the move of almost 1% in either direction for the S&P 500 on that CPI data. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens after we saw some calm return to the markets on Wall Street. Heidi, of course, we had really bargain hunting supporting U.S. equities, but we still have U.S. CPI to come later in the week. And of course, we'll be watching Apple suppliers in the Asian session.
Yeah, after that sort of disappointment, we had managed expectations going into this. We knew that it wasn't going to be sort of, a super release of a new iPhone, sort of modest upgrades to features. So it'll be very interesting to see whether that disappointment that we saw for Apple's stock price trading through to the Asian session, Shery.
Yeah, and of course, we're watching also what's happening in the currency space because we had the dollar seeing its best day in over a week. On the other side of that trade, we had the Japanese yen being pressured. Of course, we already had a lot of volatility for the Japanese currency, gains of 1% overnight, just to be pressured right now at around that 143 level. We're seeing some upside for Japanese equity markets, or the Nikkei up about 0.4% after 5 sessions of losses, of course, being pressured also by that strength in the Japanese currency. We still have the 10-year yield below that 0.9% level. Take a look at how the Kospi is coming online. We'll be watching, as we said, those Apple suppliers. We had already seen pressure on those semiconductors, especially SK Hynix, given the plunge that we saw in NVIDIA over the past few days. But the Kospi right now gaining 0.3%, while the Korean won continues to weaken. We had sort of risk-off sentiment really pressuring the broader Korean market, Haidi, and we had stocks still at around those early August lows. And remember, that was the time when we had that August 5th meltdown. We're still at around those levels, and the Korean won sitting at that 1343 level.
Take a look at how we're setting up just the first minute or so of the staggered session as we come online here in Australia. Futures were showing quite a strong pop at the open for Aussie equities as we get into the session. We're up about 0.1% there, looking like we'll see some early gains in sort of the first 10 minutes or so of about almost 1% as we see this renewed wave of dip buying potentially play through to this part of the session as well. The Aussie dollar has actually been holding pretty steady given the outperformance of the greenback 66.56. Also, perhaps a little bit surprising given the the deflationary woes that we continue to see facing China, given that we do see the Aussie often acting as that proxy trade there. Looking at US Treasury yields, we've seen kind of trimming most of those losses in the overnight sessions. Traders continuing to debate the pace of Fed rate cuts, and perhaps the US inflation numbers will give us a little bit more colour to that. Of course, there's also some risk as we get into the Harris-Trump debate as well. Seeing some of the bonds in this part of the world resuming their rally. Australian and New Zealand sovereigns opening higher. This is their 5th gain in about 6 days. Not much of a change when it comes to trading in the Kiwi at the moment as well. We're also watching oil prices, given just the broad downside that we've seen across commodities, about 0.25% higher. So pretty steady trading there as we continue to kind of track that risk on tone and potentially the impact of Storm Francine threatening some supplies in the Gulf of Mexico. Shery.
Heidi, let's bring in our next guest. Hartmut Issel is head of APAC Equities and Credit at UBS Wealth Management. Hartmut, always great to have you with us. We have talked about plenty of factors that could affect markets this week. What will be the key driver for you as we head towards U.S. CPI, U.S. presidential debates? Not to mention, of course, Chinese eco data that look weaker than we thought.
Yeah. No, I would agree. Tomorrow's CPI number, that's the key one to watch. We expected it not just down just a little bit, but I would say, unlike non-farm payrolls, for example, you probably have a lot more leeway to the downside. So if it's quite a bit weaker than people expect, I think that still wouldn't worry anybody. We're heading towards probably an opening cut by the Fed of 25. So what that means for investors, in my view, is, right, so we are slowing. The U.S. economy is slowing. There's no two ways around it, but it's not slowing at a very rapid pace. And in this environment, and with the rate cuts coming up, we think investment-grade bonds, that's probably one of the preferred trades that we would currently recommend right now.
How do you hedge currencies as well? Because although we might not get that outsized Fed rate cut of 50 basis points, we're still setting up for more rate cuts this year.
Yeah, I think there's different ways. I mean, one of course is to take an alternate currency to the US dollar. Right now, in our preference, it doesn't happen very often. Actually, we have 4 of them. So among them, Swiss franc, euro, Aussie dollar as well. Here, more closer to the region, and also the pound. So certainly a lot of choice for investors to go long one of these currencies against the dollar, which we now have as outright least preferred on a tactical basis. The other idea could be to engage in some assets, underlying assets of some of the currencies where it strengthens. So again, closer to home here, something like the Singapore REITs, for example, right, where you have bond-like trades, I would say, in equities, and you have, of course, the potential strengthening also of the Sing dollar. So these are some of the sort of armory could use for stabilizing the currency side.
How much risk do you actually assign to events like the presidential debate and or the candidate debate, I should say? And, you know, which asset classes do you think see the biggest reaction, or do you think markets have gotten quite good at discounting this sort of, murky political risk by now?
No. Maybe first one comment, because I think sometimes a bit underappreciated. Everybody understandably looks at who becomes the next president, and certainly we are too. But I think it's also interesting to see that the chances of a split Congress, for example, which usually in market terms is probably positive because it sort of prevents any sort of extreme policies to be implemented. That's probably also something to watch. Other than that, gold is certainly one of the assets, right? In case you do get a U.S. government that keeps sort of running very large budget deficits, right, on the fiscal side, if you're worried about that, especially if you're also worried to some extent, perhaps in some camps, over the Fed independence being called into question at least. By all these things, all these angles, you can cover well with gold.
I find your currency calls quite interesting. The US dollar is least preferred. Of course, we're seeing a little bit of a rebound, but I'm curious to know why you think the sort of longer track is one weakness for the greenback. And actually, you're a little bit more constructive on the Aussie dollar, despite, of course, some of the domestic issues and exposure to China. Is that purely on sort of rate divergence?
Pretty much it is, yes. In case of Aussie dollar, in fact, in case of pretty much all the central banks, so we don't think anybody cuts as much as the Fed over the next, say, 18 months or so. So Aussie dollar, here's also one, where the rate differentials then play a role. Another one, perhaps also very pronounced, is Swiss francs. So S&B, for example, we think that they're almost done. Right, possibly one more cut, and the Fed has not even started yet, and we're seeing multiple cuts. So even though you could argue to some extent the market has priced in some of it, but we would argue certainly not all of it. So yeah, again, plenty of choice on the currency side.
Is the yuan one of your choices? Because I wonder, we have seen this rally of about 2% this quarter, but I mean, if the economy continues to weaken, who will want to repatriate money if there are really no investment opportunities within the country?
Yeah, not necessarily among those. A, as you rightly mentioned, the fundamental side. B, we just discussed the election, right? So you can also paint some scenarios, at least, where this is also not so favorable in case, the trade tensions flare up, etc. So, yeah, I would probably go into other currencies as long legs right now.
Hartmut, always great to chat with you. Hartmut Issel, Head of APAC Equities and Credit at UBS Wealth Management. More ahead on the Asia trade. This is Bloomberg.
On September 10th, as Election Day approaches, Vice President Harris and former President Trump hit the stage for the first time.
Oh, we're going to beat her. I look forward to the debate.
If you got something to say it to my face.
We'll bring you informative analysis.
Will that debate decide the outcome of this election?
It's going to come down to both policy and performance.
Tune in to Bloomberg Television for the ABC News presidential debate simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
Take a look at Apple suppliers across Asia. The company rolled out the iPhone 16 and set the stage for a new AI platform. Apple shares were down during the launch event in the overnight session, almost 2%, but they managed to finish unchanged. We're seeing downside pressure across the board in Asia. For more, let's bring in Bloomberg technology reporter Mark Gurman. Mark, I mean, expectations were already low going into this event, but what were your key takeaways?
My key takeaways are that Apple is hinging on Apple Intelligence to sell its new iPhones, despite the fact that Apple Intelligence, for all intents and purposes, does not yet exist. The new phones will go on sale on September 20th. Apple Intelligence won't begin rolling out until mid-October at the earliest. And even then, it's only going to include a subset of features. Many features are coming in December. Everything they've discussed in terms of a revamped Shery, that's not coming until around March, April of next year. In addition to that, essentially all of the Apple Intelligence features that are available on the iPhone 16 line are already going to also be available on the iPhone 15 Pro and Pro Max from last year, meaning that anyone who has one of the phones from last year, as I do, you don't necessarily have a good reason to upgrade. I don't find that the processor leap is compelling. I don't find the camera improvements compelling, and I don't find the camera control update worth the price of admission if you have last year's phones. But of course, Apple's not building new phones for the prior year cycle. They're building new phones to get people from the Android ecosystem and to get people on older iPhone models, right? So if you have something older than the 14 Pro, you're getting last year's plus this year's improvements, and maybe it's the right time for you.
Mark, I came into this thinking, well, surely Mark's found something to be excited about this, right? And if even you are not finding this release that compelling, does that put Apple in a difficult spot in terms of market competition? We see the likes of Huawei really being quite good at closing the gaps, particularly in EMs and in the Chinese market.
Well, as you know, I'm very opinionated, and I have my opinions, and I think I'm absolutely right that these are not compelling upgrades. But I'm also knowledgeable about the industry to know that my opinion is not necessarily the opinion that dictates Apple's sales. And so while what I'm saying is a dose of reality, The other component here is that demand for Apple products, interest in Apple products, and the love of Apple products by billions of people around the world is not fading as much as some people may think. And so you are going to still see strong demand. You are going to see a lot of interest, right? But I don't think you're going to see as much demand and as much interest as you would see in a year where they had more compelling hardware changes. I simply don't think Apple Intelligence is something that is going to spur upgrades and spur demand. I think what's going to spur demand is pent-up demand, meaning people who haven't upgraded their phone in a few years, people who've broken their screens, people who have cracked cameras, people who have batteries with the battery health of 72% versus the full 100% that you'd get from a new iPhone out of the box. So I certainly think that that is what's going to drive upgrades this time around, not these new features.
Yeah, my iPhone is pretty old, but I am excited about that physical camera button. Given the lack of excitement, given the potential lack of a big refresh cycle, what does that mean for suppliers across Asia?
Well, in terms of suppliers, what we're seeing is stagnant. If suppliers think they've had a good year over the past 12 months, they're going to have a good year for the next 12 months because just like over the past 12 months, they've produced 80 to 90 million handsets. They're going to produce another 80 to 90 million over the next 12 months. So I think for suppliers, if things have been okay in their view, I think things will continue to be okay, right? There's no super cycle happening here. But on the other hand, there's also no collapse happening here either. Sometimes it's okay that everything is still the same.
Bloomberg technology reporter Mark Gurman there. Well, pretty quickly, following on the heels of Apple, Chinese tech giant Huawei will officially launch its latest smartphone. Let's discuss all of this. Our tech reporter Annabelle Jewellers joins us in Hong Kong. We saw kind of some of the Huawei-related suppliers gaining on the trifold, I should say, phone pre-orders. What do we know about interest so far, and I guess how it's playing catch-up now?
Yeah, well, it's pretty interesting. I mean, a lot of different outlets are sort of reporting that we're already getting really robust pre-sales, and that is, I guess, true to an extent, but I do think it's important to give the context around this. So, yes, pre-sales have started. They actually kicked off over the weekend, and you can see on Vmall, which is Huawei's e-commerce website, that we've got around 3.3 million reservations that have been made so far. What is important to note is that there's no charge to pre-order, so you could actually just be expressing interest. The pricing hasn't been revealed just yet, so perhaps if you weren't compelled enough when the phone is officially launched later today, you could retract that pre-order. But that is the indication we've got so far. 3.3 million people have so far expressed their interest. That's really the way to think about it. But the design of it, of course, it's quite an interesting one, bringing it to the market, because it's that trifold. You're essentially getting a lot more screen space, and so Huawei is really trying to make its mark here in that higher-end market space.
And what supplier stocks are we watching then?
There's a handful that we're watching off the back, and yesterday, again, given we already had those indications around pre-sales coming through, we started to see them rising. These are all China-based names. You've got CPT Technology, for instance, that sort of works in the electronic components market. A couple of others. Again, you're seeing some pretty strong moves so far, especially when we had quite a lackluster trading session yesterday in the light of those inflation numbers coming out. But again, the context of this is quite an interesting one, because we have seen Huawei really managing to gain market share in China. It actually edged out Apple in the latest quarter. How long that persists will be something, of course, to track over the coming months, given you've got a low baseline for Apple in the country now year on year. And so you are seeing actually stronger numbers coming through just off that. But Huawei, again, no sort of mistake that they're really pitting its latest product against the iPhone 16 launch. And as Mark was just saying there, perhaps not so many compelling features in the latest iPhone lineup. Perhaps Huawei's new Mate 60, or XT rather, could attract some consumers.
Annabelle Jewellers in Hong Kong. Let's now turn to banks. The latest stories that we're following at the moment, Goldman Sachs CEO David Solomon warning that business for the bank's trading unit is on track to drop 10% from the previous year. That's led by declines in the fixed income business. The company will also take a $400 million pre-tax hit in its consumer business as it moves away from its credit card tie-up with General Motors.
First, with respect to trading, I would say that with FICC and equities, we had an extremely strong third quarter in 2023. And given this quarter, given what I'd say is a more challenging macro environment, particularly, in the month of August, that business is trending down close to 10%, largely due to FICC.
HSBC is said to be considering combining its commercial and investment bank units in a bid to cut costs. The combined division would become the bank's largest revenue generator, contributing about $40 billion a year to HSBC's coffers. Bloomberg Intelligence senior analyst Matt Ingram joins us now for more. So it feels like, just constant rate of change when it comes to HSBC, right? What is the intention here, and how does it shape up in your view in terms of being able to attain those savings and efficiency?
G'day, Heidi. It almost seems like a case of new CEO, new restructuring at HSBC. We saw it with Stuart Culliver, we saw it with Quinn, now we're seeing it again. It doesn't sound like what he's telegraphed. He said that the changes would be sort of minimal or not significant, and this is a massive change. The synergies between those two businesses are questionable. Yes, you would cut costs, but the question is, do you take away flesh as well? How is there synergy between banking a small business versus banking a global conglomerate? So it's not new news. HSBC said telegraphed that they're going to cut a lot of positions, particularly middle management, but I fear this one might take away flesh, and I think revenue is going to be hurt if they proceed on this basis.
There was internal resistance when this had come up before, so why are they sort of bringing it to the fore again?
Look, I think it's important that this has been floated. This is certainly not an official plan as yet. I guess they're looking around at low-hanging fruit, and it might seem, gee, there's a lot of relationship bankers in commercial and in global banking and markets. Maybe we can cut some of those high-cost relationship bankers. I think they're going to go full circle on this again, and they're going to realise, as I said before, there's a revenue impact to doing this. This isn't just about cutting costs, and so they have to be extremely careful.
So what are some of the next moves that we should be watching out for?
Hey, Shery, look, it's still a spaghetti network of management across the world. They've got a combination of business structures, geographic structures. From what they've said so far, I think the next step is still to have a close look at some of those geographical networks and maybe break those down, as well as perhaps getting rid of some of those intermediate steps in terms of the management structure. In terms of a big restructuring, that's a dangerous move for a new CEO. I would say he's going to hasten slowly in that one. I think we're going to see some of that geographical stuff further broken down and perhaps a compression within existing business units to start with.
Bloomberg Intelligence senior analyst Matt Ingram there. Was sticking to banks. We're hearing some recommendations, Shery, from Australia's banking regulator in terms of the future of these AT1 bonds. So we're hearing from the regulators that they're proposing lenders phase out the use of the so-called CoCo bonds, AT1 bonds. This is the kind of securities that were wiped out, if you recall, of course, with the collapse of Credit Suisse, to strengthen their capital holdings in the event of a crisis. The Australian Prudential Regulation Authority, in a statement, saying the proposed changes seek to support financial system stability at times of crisis with simpler and more certain resolution of banks in the unlikely event of failure, aimed at reinforcing confidence in the safety deposits at times of stress. So this transition under the proposal would start on the 1st of January 2027. That means all current AT1 bonds on issue are expected to be replaced by 2032. They had started looking at this process in September last year, but it's interesting because I know in Japan, of course, the mega banks were some of the first to venture back into that market after the Credit Suisse collapse.
Yeah, we had some of the big banks like Mizuho Financial issuing billions of dollars of these AT1 bonds, as you say, after that collapse that we saw in Europe. It was also followed by other companies as well, Mitsubishi UFJ, Sumitomo Mitsui as well. So really a little bit perhaps a sense that it's less risky. Here in Japan, we saw the risk of investing in Japanese AT1s as lower than such bonds in other jurisdictions. That was sort of the thinking by some of these market participants. So, as you said, we saw those Japanese banks really opening the way in the AT1 market. We have more ahead on the Asia trade. This is Bloomberg.
From the latest corporate headlines that we're following, Honda will reportedly reduce staffing at its Chinese joint venture with Dongfeng Motor. Japan's Nikkei says a voluntary cuts apply to production workers at 3 factories that mainly produce petrol-powered vehicles. It is Honda's second joint venture in China to undergo job cuts this year as the company moves towards electrifying its products. Oracle shares surged in late trade after better than expected quarterly profits, signalling that AI demand continues to boost its cloud unit. CEO Safra Catz says cloud services have become Oracle's largest business as quarterly revenue rose by 7%. It also announced a new agreement to make its namesake database available on the Amazon Web Services cloud. Midea has started taking investor orders for its share sale in Hong Kong, which could be worth as much as $3.5 billion, making it the city's biggest listing in more than 3 years. The Chinese appliance maker says it expects to price the shares on Friday and begin trading a week from today. Sources say order books were covered as of Monday, Cornerstone investors taking more than a third of the offering. Shery.
Heidi, take a look at the commodity space. Of course, we have seen a lot of pressure in commodities given the weakness in the Chinese markets, especially with the latest economic data and deflation really spiraling in the country. We're seeing Brent holding at that $72 a barrel level. We had seen it really hold on to that one-day gain. Risk on tone perhaps returning in the Wall Street session overnight. We saw equities being supported, but we have seen significant downside pressure when it comes to oil markets, not to mention iron ore. Remember, we're still trading at around those lows seen since 2020. When it comes to copper prices, we saw a little bit of a rebound in the previous session, climbing back about that $9,000 level. This, of course, perhaps on signs that we might see that Chinese demand returning.
Taking a look at how European stocks are opening when it comes to the futures session, Shery. Stocks 50 futures looking a little bit buoyant, particularly when it comes to German DAX futures, up by about 0.25%. So looking to extend that rebound that we saw from the start of the week from, of course, the biggest weekly drop in about 18 months. Again, it's that key US inflation data, ECB rate decision this week in focus there as well. We're expecting to see some further upside at the open. This is Bloomberg. We are getting consumer confidence indicators coming out for Australia. And of course, this sort of further adds to the consumer pessimism that we see, given the cost of living crisis, sustained higher rates, and really the likelihood that the RBA is sort of well behind when it comes to the global easing cycle. We are seeing that Westpac consumer confidence falling to 84.6. That's down 0.5% month on month there. The economic outlook, employment prospects, really some of the aspects of a rising concern. Interest rates at that 12-year high and expected to remain there for the remainder of the year. So pessimists there in the latest survey, heavily outweighing optimists. A reading of 100, as a reminder, is that demarcation line for this survey, and it's actually sat below that 100 level since March 2022. Westpac senior economist Matthew Hassan saying that pessimism that's dominated for over 2 years now, showing no real signs of lifting. Shery.
Yeah, take a look at how markets are trading at the moment. We are seeing the Nikkei down 0.4%, while the Kospi is down 0.2%. We have some of those Apple suppliers under pressure in today's session, but broadly speaking, we have seen the tech sector under pressure for quite a while, especially with Nvidia's plunge last week. The ASX 200 up 0.6%. Heidi, we had the Aussie dollar actually being supported in the previous session after the biggest weekly drop since July. We're seeing a little bit of buying by local exporters.
Shery, China hawks in the US House have passed legislation seeking to blacklist Chinese biotech companies and their American subsidiaries. Backers of the Biosecure Act argue that it will prevent Beijing dominating another field that the US pioneered. Let's bring in Bloomberg's congressional reporter Stephen Dennis for more. So, Stephen, what are the key points of the bill, and sort of where do we expect it to go from here in terms of the anticipated level of support when it heads to the Senate?
Yeah, so the bill basically blacklists, a handful of these big Chinese biotech companies from accessing sales to U.S. pharmaceutical companies and research companies and institutions that use their products and services like these big DNA sequencing machines to try to do precision medicine. It's really the hot new part of pharmaceuticals and healthcare. And there's a concern by the lawmakers that passed this bill that China would come to dominate this field and could use the data for nefarious purposes. And the companies deny that. They say that they don't vacuum up this data from Americans and that they aren't doing anything wrong. And they complain that this bill was sort of singles them out and doesn't have a process for them to come off of this list. And there were some people who bought that line of argument and opposed this bill, but the vast majority of the House supported it. It looks like the vast majority of the Senate is also going to support it, but there's going to be an ongoing effort by these companies to water down the legislation, preferably in their view, to not name the companies and instead have a set of rules for protecting data that goes to the administration and have the administration then determine if companies are protecting data or not protecting data. Right. But the bigger whole question here is whether or not the U.S. and China are going to have a cooperative relationship economically or not.
Well, already earlier this year, we saw the moves against TikTok, right? I mean, they would be banned unless ByteDance divests. How would this compare to that?
This is really the same kind of bill where basically these companies have to give up their U.S. businesses to some other competitor or else. And this is, a new way of Congress acting. Normally, they don't single out individual companies like this, like they did with TikTok. And there's, I think, the potential for many other kinds of bills that sort of target these big Chinese companies, including in the electric vehicle space, in the drone space, where China dominates the market for consumer drones, for example, in the United States. There's efforts to ban those companies. So this is something where Congress has big bipartisan majorities. This is something that was not the case a decade ago, where some of these companies were bought by Chinese companies and are now subsidiaries of Chinese companies like Complete Genomics. And so that this is something that could potentially affect these companies' stocks and businesses if they can't slow or stop this in the Senate.
Right, Bloomberg's congressional reporter Stephen Dennis there. Now, Pope Francis is in the middle of an Asia-Pacific tour to connect with Catholics in countries including Indonesia, Papua New Guinea, and Timor-Leste. But Bloomberg opinion columnist Karishma Vaswani says the trip is a dress rehearsal for a more coveted prize, a potential visit to Beijing. She joins us now from Singapore. Karishma, how important is China for the Pope?
Hugely important, Shery. And just to say that Pope Francis will be in Singapore this week as well. It is the last leg of this historic voyage, and this discussion about China should surely not take away from the trip that he has been making throughout the region, where there are sizable populations of Catholics in those countries. But specifically with regards to China, it's been a stated ambition of the Church to try and heal and bridge the divide there. Now, for the purposes of explaining to our audiences what that specifically means, there are Catholics around between 10 to 12 million, according to independent estimates in China, many of whom practice or worship under the Communist Party, and many of whom practice or worship in secret in underground churches, pledging their allegiance to the Catholic Church. This is seen as what is known as a schism in Catholicism, and that is something that the Pope is trying to heal, to bridge that divide, and that is why China is so important to the Catholic Church.
China has such a deeply complicated history when it comes to allowing and controlling religious freedoms. Is there a way to kind of see these compromises being made, right? Would the Catholic Church want to make these compromises going forward in these overtures to the Communist Party?
I don't want to speak on behalf of the Catholic Church, but certainly from what I've observed in my reporting and research, what we've already seen is in 2018, there was a sort of compromise struck between the Church and China, one that was heavily criticized by many high-profile members of the clergy who said that the discussions around the appointment of bishops, which historically in China, the Communist Party has controlled, and now as a result of this agreement between the Church and China, the two sides would end up appointing candidates together. Many members of the clergy, including the now retired Cardinal Zen of Hong Kong, said that this was effectively ceding far too much control to the Communist Party. Now, as you point out, Heidi, there is a great deal of concern over religious freedoms in China. There is a lot of data to point to the fact that religious oppression is a real problem. And in my column, I argue that sacrificing principles for progress is not the way to go about trying to heal this schism in China.
Bloomberg opinion columnist Karishma Vaswani there in Singapore. Much more ahead on the Asia trade. This is Bloomberg. We just took a look at a few minutes ago. Australia's consumer confidence numbers for September continuing to languish under that level of 100, as it has been over the past couple of years. And weak consumption has been weighing on growth. Last week's GDP numbers showing consumer spending slowing to a crawl in the June quarter. Bloomberg's Paul Allen takes a look at why Australians are keeping such a tight grip on their wallets.
Australia's consumers are barely worthy of the name right now. Interest rates on mortgages have been rising as ultra-low fixed-term rates roll off. Inflation's running at 3.8%, still outside the Reserve Bank's 2 to 3% target range. Any spending that is going on is mostly on the bare essentials.
It's no respite, mate. Like, your salaries aren't growing with cost of living.
We're basically working just to pay off our bills as opposed to really spending time with our kids.
I'm currently working about 4 jobs right now.
It was only a rise in government spending that stopped Australia's GDP from contracting in the June quarter, with growth accelerating by a mere 0.2%.
The main story in these figures is consumption. Consumption went backwards and discretionary spending fell substantially.
The weak growth reduces the likelihood of any further tightening from the RBA, but with inflation still not back to target, relief in the form of a rate cut for Australia may still be months away. Paul Allen, Bloomberg, Sydney.
Well, next guest runs Wesfarmers. This is one of Australia's largest listed companies and one of its largest private employers and its largest non-food retail group. Brands include the likes of hardware chain Bunnings, the budget-friendly Target and Kmart. Joining us now is Wesfarmers Managing Director and CEO Rob Scott. Rob, really great to have you with us, and of course, such pertinent timing in terms of these cost of living and interest rate woes that are confounding lots of households. I wanted to start by asking you, what's your gauge of the Australian consumer at the moment? How do you feel in terms of your business, how that sentiment is being expressed?
Well, there's certainly a degree of caution within Australian households and how they're spending their money. We are seeing a real focus on value, particularly from younger families that have mortgages, are facing a lot of challenges with higher costs of living. So what we're doing in our businesses like Bunnings, Kmart, Officeworks, that are renowned for everyday low prices, we are really trying to double down now to keep our prices really low. And that has served us quite well in terms of maintaining some sales momentum during difficult trading environments.
You just mentioned the sort of fight to keep prices low. How is that front when it comes to your costs and whether you're able to continue to provide those low prices, particularly in an environment where we're seeing, online businesses like Temu and Shein taking such a big chunk of consumer attention and spending?
Well, one of the challenges that all Australian businesses are facing at the moment is cost of doing business pressure. So we've seen quite significant increases in wage costs, in power costs, domestic transport, utilities, and accommodation. Rents are also going up. So all of these factors are pushing up the cost of doing business, which is putting more pressure on domestic costs. So what we're doing in our businesses, we've invested heavily in a lot of technology to try and drive efficiency within our businesses. So, for example, if you look at our Kmart stores, we're now using RFID technology to better manage our stock, improving availability, making it easier for our team to manage our inventories in store. They are just one of many examples of ways in which we're trying to drive efficiency, drive productivity in order to keep our costs down so we can then keep our prices down.
You talk about Kmart, but you already had a very strong growth year for fiscal 2024. Can you continue that level of growth, and what brands will drive that?
Well, we're really determined to keep our prices low at a time when households are really looking for value. And Kmart is well regarded for having not only everyday low prices, but also having some really innovative products that are now providing accessibility to some products that simply were not available outside of specialist stores that had much higher price points, such as health, beauty, cosmetics, youth fashion, a lot of accessories for the home. All of these things are really resonating with customers. So I think that combination of keeping our prices low, but also leveraging some of our unique design capabilities to bring new products to market, that's what we're really focusing on in the current environment.
And Rob, to Heidi's earlier point, how do you see competition with Chinese sites like Shein and Temu, not to mention Amazon as well, I guess?
Well, I think it's a good point that you make. We have a very competitive retail environment in Australia, and sometimes I think people just focus on the Australian competitors, but we are up against some of the largest, most formidable retail competitors in the world. And you mentioned some of the large Chinese e-commerce providers, you mentioned Amazon, and we are having to fight really hard to ensure that our products and our value are very competitive. And within Wesfarmers, we've invested significantly in our e-commerce capabilities. We are offering free online delivery across Australia through our OnePass membership program, which is a subscription program. We've seen really strong growth of e-commerce within Kmart, nearly 20% growth. So we are getting some good traction there, but we are fighting a fight against those big international companies that you mentioned.
We just saw in the latest consumer confidence numbers an indication that households perhaps have moved on a little bit from cost of living pressures, which may have alleviated slightly, and interest rates to kind of more of a longer term concern over the direction of the economy and employment as well. Are you seeing that through, the risks to your business, and do you feel like there's been policy missteps? Do you think that the RBA should have started easing by now? Would that take the pressure off the consumer?
Well, I think from an RBA point of view, I think the RBA is very mindful of the fact that inflation is still running quite high. So I think they are adopting a very responsible and prudent approach to trying to get inflation under control before we see decreases in interest rates. I think that there are many things that can be done on the policy side, certainly around the supply side issues, to help improve housing affordability. We need over 1 million new homes in Australia, and there are many supply-side challenges that are preventing people from investing in new homes and undertaking renovations. That goes to availability of skilled labour, some of the challenges with planning approvals. These are all issues that I think could be enhanced and improved with good policy, and that ultimately will improve the inflationary pressures, improve the housing affordability, and improve the economy over time.
You mentioned the building sector weakness, and I do wonder, has that played through to the business at Bunnings? How are you seeing that sort of split between retail and commercial, and are you seeing diversification efforts in some of these other groups perhaps helping alleviate that?
Well, I think we've benefited in Bunnings because we have a very diverse set of products and a very diverse set of customers. And at the moment, our DIY consumer spending is holding up reasonably well, but we've brought a lot of value to our offer, and we've also expanded our product range in some new areas. We are seeing softness in residential construction. That only accounts for about 10% of our overall business. But I must admit, it is quite frustrating because we're seeing very strong demand on the renovation side and the housing side, but we are facing these skill shortages that I mentioned with trades, and a lot of builders are still lacking the confidence to lock in fixed price contracts. And in an inflationary environment, households and investors want to get the confidence of locking in a price if they're going to do a renovation or build a new home. So these are some of the challenges that we're facing with residential construction, which are also putting upward pressure on rents and housing prices.
Rob, you're also, of course, one of Australia's largest employers and private employers. What's your gauge of the labour market at the moment, both from the costs and wages perspective, but also just the availability of staffing, given there's some pressure that perhaps, immigration and international students might have to be pulled back?
Well, I'd say at a macro level, unemployment is still fairly low in Australia, and that is a real positive for the economy, and it is positive if people want work, they basically have work at the moment. But we are seeing skill shortages in some key areas. To give you an example, as we are developing our state-of-the-art lithium refinery in Western Australia, we've had to fly labour in from the east coast of Australia just to meet some fairly basic roles around welders and electrical contractors. So that goes to show that there are still some pretty significant labour shortages in key areas that are critical to Australia's future and the future of investment here. But I think we need to be mindful that many of our industries in Australia are internationally competitive. We have seen some softness in global commodity prices. We have seen some projects start to slow down in the areas of lithium and other value-added production, certainly here in Western Australia. So I think we do need to be mindful that we are well positioned to attract the investment, that we have the skills that are necessary to drive this value-added investment, or things could turn if we're not careful.
As a CEO and, of course, managing such a significant workforce, what are your thoughts on the new right to disconnect laws?
Well, look, I think it's a fairly small change in the scheme of things. And as we've said along the way, in Wesfarmers, our businesses have very respectful relationships with our teams. Our teams want our businesses to be really successful. So we already have a very respectful arrangement if we need to contact a team member outside of office hours. So the regulation that we're now faced with, I see it as largely unnecessary. It probably just goes to the fact that we now have hundreds and hundreds of new pages of workplace relations regulations, many of which don't really do much about improving wages or conditions for team members, but they add additional cost and compliance that businesses must address. So, look, it is a shame that I'd much rather see some of the focus around industrial relations focus on areas that can drive a real win-win arrangement between businesses and their team members. I would love to pay our team members more, and we have a great track record at Wesfarmers paying our teams more as our businesses are more successful. So that's what we're really focused on within our businesses. It would just be good to see some of the regulation be more constructive around driving that win-win outcome.
Rob, really great to have you with us. Rob Scott, CEO at Wesfarmers. We have more at this time every week on Australia Ahead. That's Tuesdays at 10:40 a.m. if you're watching in Sydney. More ahead on the Asia trade. This is Bloomberg.
Take a look at how we're trading across Asia right now. We are seeing the Nikkei gaining 0.2%, being led higher by financials and consumer staples, although healthcare and utilities are pulling the market down. We're, of course, watching the Japanese yen holding at that 143 level. We're also watching the Kospi turn positive from losses earlier in the session. We're following the Aussie yen as well, given that Australia's consumer confidence dipped in September. We do have rising concerns about the economic outlook. We have interest rates at a 12-year high in Australia and expected to remain there for the rest of the year. That's it from the Asia trade. The China Open is next. This is Bloomberg.